Relevant costing. Relevant costing is a decision-making technique in costing which is used to evaluate short-term decisions. Relevant costing is also called as differential costing, and some authors also define relevant costing as incremental costing. So a number of decisions can be evaluated by using the relevant costing principles, such as make or buy decisions, accept or reject decision, special price decisions, further processing decisions, etc. So let's have a look. What is relevant costing and how does it help us? So relevant costing is a management accounting technique which is used to make short-term decisions by taking into account only relevant costs and revenues and ignoring non-relevant ones. So while we evaluate any decision, we only consider or take into account the relevant costs. And any non-relevant or irrelevant ones are ignored in making the decisions. Now, question is, what are considered as relevant costs? So please remember, relevant cost includes any cost which is cash based. So as a result of making a decision, the cash will be incurred. Cash will be incurred as a result of making the decision. So it is like a cash expense or cash cost. Then relevant cost is future based, meaning that we make a decision and the cost is incurred or even revenue is generated in future. Anything happened in the past is not relevant. Then relevant cost must arise actually as a direct result of the decision, that we make a decision and as a result of the decision the cost is incurred. That cost which has been incurred or which is being incurred as a result of making a decision is called as relevant cost. Relevant costs include incremental cost and revenues. So incremental means additional. So we make a decision and as a result of the decision any additional cost is incurred or additional revenue is generated. So that increment is called as relevant. So you probably have noticed that what is opposite to the incremental, meaning if there are two decisions to evaluate and there is any common cost between the two decisions, then that common factor or common cost is not relevant. Only change is relevant. Opportunity costs are relevant. So what are opportunity costs? Opportunity costs are any benefit gained as a result of giving up another one. Okay, so when we forego any opportunity as a result of the next best alternative is called as opportunity cost. Any direct or specific costs which are specific to the decision are relevant. Okay, now we are going to look at non-relevant or irrelevant cost. So opposite to the future-based is past. Any expense incurred in the past is sunk cost, and that is irrelevant and ignored in evaluating a decision. Any non-cash costs, so which is opposite to the cash-based cost. So we make a decision and the cost is incurred but not in form of cash, such as it could be depreciation or any amortizations, etc. These are, or use of idle time, that we get some workers on the new job like as a result of decision, but we don't need to pay those workers because they were sitting idle somewhere. So use of idle time is also non-cash type of cost, which is irrelevant. Any common or joint cost which is opposite to the incremental effect. For example, think about further processing decisions, that we have already produced the mineral water and now we are thinking, should we process it further to make it vitamin water or any fruity flavored water? So if we are going to convert the normal drinking water into any fruit flavored water or vitamin water, then what is common between the two type of waters? Well, yes, you are very right. The water itself is common cost between the two, and that will be ignored as common or joint cost. So any additional or incremental cost incurred will be relevant. And last but not the least, committed or general fixed cost or absorbed overheads are irrelevant because they will be incurred whether we make one decision or the other. These are commitments and they will be incurred anyway. These will not be incurred as a result of the decision, and that's the irrelevant. So please remember, in evaluating any financial decision, we only take into account the relevant costs by ignoring the non-relevant costs. Thank you.